Global stock markets take a knock and the dollar holds near two-year highs as the Fed pushes back on rate cut calls. This week has seen a number of market holidays driving lower levels of liquidity than usual. European markets were closed Wednesday, Chinese markets since Wednesday, and Japanese markets all week. This has left much of the focus on the US economy and the Fed in particular. Ahead of the FOMC meeting, markets were in a good mood. US equity markets hit an all-time record high, and President Trump tweeted that the US economy would go up like a rocket if we did some lowering of rates. Fed Chair Powell clearly didn't take the hint, however. In a rigidly worded statement, the FOMC upgraded its description of economic growth to solid, and in the press conference, Powell noted that the fall in core inflation to just 1.6% in March could be due to transitory factors. While Powell was asked several times about rate cuts by members of the press, the chairman remained constructive but cautious on the outlook for the US economy and reaffirmed the view that the current stance of monetary policy is appropriate. This is not what markets wanted to hear. Money markets were priced about 90% for a rate cut by the end of the year, and the Fed's unwillingness to validate the easing priced in to markets knocked US equity markets back from a record high and lifted the US dollar. Now, markets will closely be watching the monthly non-farm payrolls report to be released later today in the US, where lead indicators suggest a healthy 180,000 rise in jobs. This mix of a strong US labour market, some signs of rising wages, a constructive but cautious Fed that sees weak inflation as transitory, leaves the US dollar on a solid footing coming into a big week next week for monetary policy in Australia and New Zealand. Both the Reserve Bank of Australia and New Zealand meet, and with swap markets pricing a May rate cut at around 50% chance for both, all we can say with confidence is both markets should react sharply to the rate decisions, though Westpac is forecasting no change for the RBA and a rate cut in New Zealand. With the Aussie dollar trading at 70 cents to the US dollar, the risks seem asymmetric. There may be only a fragile 40 to 50 pip bounce on no change, since the statement should include admission that growth and inflation forecasts have been cut since February and adopt an easing bias. A rate cut, however, could cut a full cent from the Australian dollar as markets scramble to price in the next easing and ponder how soft the economy must be for the RBA to cut rates 11 days before the federal election. Again, Westpac is forecasting no change from the RBA next week, but cuts in August and November and 68 cents for the Australian dollar by September. In New Zealand, we see the market's 50% pricing as more justified. The March meeting signalled an easing bias, but since then RBNZ Governor Orr's comments have been less dovish. And global growth, previously a major RBNZ concern, has at least stabilised. Against that, CPI and wage inflation remains subdued and jobs growth appears to be slowing. The New Zealand dollar should thus continue to underperform, and we target 65 cents by year end, assuming of course an OCR cut in May and US economic growth outperformance. Over and above the RBA meeting Tuesday, we have March retail sales and merchandise trade balance released the same day, plus the important statement on monetary policy on Friday, where we expect to see the RBA downgrading GDP forecasts and paving the way for our August cut call. In terms of the global focus, post the FOMC statement and Powell press conference, Fed speakers will be important with a total of 14 engagements over the next week. Chinese negotiators will be in Washington next week too for what feels like a final make or break stages of negotiations on a trade agreement, and a positive outcome here would lift market sentiment. These are all factors we'll talk about in next week's markets update.